Hello everyone and welcome. My name is Tim from the Camp Compound and today we are going to look at the market as well as some of our open and recently closed positions. So let's get right to it. We have in front of us the S&P 500, or also known as the spider. And what we see here is that we've had this bullish consolidation phase that we saw, which also slightly broke this upward wedge. And now we have broken through it on the downside, which generally means that there's a lot of selling pressure if you can't finish the bull pattern to the upside. So a lot of selling pressure, slowly moving back towards this trend line right here. We see the similar thing in the Nasdaq. This is the triple Q. The Nasdaq still has further to go, which means that especially risk stocks are a bit more vulnerable at the moment as they have more space to fall back down. We can measure the exact weight here. That is about 7% in the Nasdaq as opposed to maybe 1 or 2% here in the SPY. Yeah, 1% approximately. That could mean that either risk stocks will fall further over the coming days as this comes home to roost, or the S&P 500 will break through this trend line and maybe move a bit lower towards 388 or 378. I'm sorry, I'm still a bit ill, so my apologies if I cough in between. I will try to keep it to a minimum, but if you're ill, you're ill, and I still want to get these videos out, so we'll just have to deal with it. Anyway, that is kind of the base overview in the market at the moment. We can have a quick look at what the weekly chart looks like. You see that there's a bit of a gap, not perfect, but or not that huge as gaps go. We do see that we've not yet managed to fill this gap properly, but we might just move back down towards either this 382 or kind of try and make a higher low. Our higher high was not that impressive, but we don't see a bearish divergence just yet on the weekly, which is good because that would be very damning. But on the daily, we also don't really see a bearish divergence currently, which is a good thing. That means that there's not an overwhelming force of sellers about to step in. Same thing, I believe, for the Nasdaq. If we grab the RSI, we see there's not that much of there's not really a bearish divergence, which is good to see for the moment. The Nasdaq did not quite break. That is a regression trend. That is not the one I wanted. There we go, parallel channel. It did sort of break its bullish pattern, not quite yet. If we can confirm below it, so if we close below and then have another day lower tomorrow, we might see this trend line being tested fairly soon. So keep that in mind, especially with your tech stocks and possibly crypto as well. Now, if we have a look at a couple of our positions, here we have JPM where we're in a short. I can close the RSI, that's fine. Let's have a look because we see that the market is kind of not feeling it, not feeling great. We have this triple top here. It did kind of break through on 2 occasions, just a little bit, not that much, barely closed above and was rejected again. We also see that the RSI is just steadily moving downwards and now trying to see if it can hold under that 50, which would turn it bearish. So what we could see is a move back down towards this low if we can properly break under this little support here of the 138, meaning that we could move towards the next support of 133 and quite possibly 128 and 122. That's kind of what we're looking at, but you do see that there is a pretty decent level right here waiting for us. So that is kind of what we're looking at currently. I mean, that would still be about a 4% move, so we would probably be looking more towards the 122 for the moment. That's that for JP Morgan. We have AAL, American Airlines, as well. It's doing a little bit better. We had a very, very nice entry on that at 1735 for a short. It's doing perfectly. It is currently it just did not fill the gap. That would be a decent place to get out because we have the top of this range right here and a gap fill. We just did not quite fill it, and that would be about a 10% gain, which would be decent. Afterwards, it's a bit more of a guessing game where it's going. It depends a bit on whether or not it manages to break and pierce. If it does pierce, you could see towards that 13, but really having a 10%, not trying to make the great 30, 40, 50% hits. Not that this would be that. I think that would be like 20, 30 maybe. Yeah, 20 to 30%. But the consistent 10% gains is what we'll really consider will really make your account grow over time. So keep that in mind. We also closed Netflix today, which was decent. We had another perfect entry here with that triple tap fake out above. Not quite a topping tail. I think I would have to measure that out. Doesn't matter. It was still a very pretty setup. And now we closed it right here. Could it go lower? Yes, definitely. It might drop all the way to 27 or 278. But like we just said, taking those small wins consistently and slowly taking your positions off the table. This is 12%. It's very nice. And slowly leaving some to run is how you grow your portfolio, compound it, and grow it actually really fast once you kind of hit your swing. So that is what we're looking at here. And then gold is taking a bit more of a beating. We're in a long, also kind of for our, our commodities play. We've been talking about over the past couple of weeks. What you see here, this was a very strong support. Now we've pierced it. We might just see a confirmation below, meaning that we could perhaps pick up a bit more around that 15.3 dollars approximately. For the rest, it's a very rough slide at the moment for commodities, but especially here for this miner. This is a very steep wedge, meaning that we might see a bounce soon. We can also kind of see that in natural gas and in oil, where there is a bit of a bounce right now. Compression seems to be trying to break and try to break to the downside, fake out. There's a lot of games being played right here. So wait a minute. I would personally wait for oil to kind of get back into a new swing of things. It is kind of consolidating slightly upwards after moving down, which is generally not a good sign, but it's compressing in general. So just wait for it to pick a side and then continue onwards. Natural gas is trying to reclaim this little pocket right here after breaking down. Did not properly confirm. This is why we wait for confirmation, because this is a fair breakout. Now it's trying to get back above and maybe even make that inverted head and shoulders. Do you see it forming? Let us grab the pathing tool. Say we have it right here, up, down, back up, and then maybe a tap back here before moving around. That is what we're currently seeing. Let's make that a bit brighter as well. There we go, maybe something like yellow. There you can see it properly now. Something like that could happen. It's not set in stone. It's just kind of making that first pattern so that you can kind of see it and kind of start to anticipate the market as well. Because if you only recognize the head and shoulders pattern once it's already here, you're too late. So that's what we're currently looking at. Let's have a quick look at gold. For Barrick Gold, we see that gold itself is in a bit of a slump together with the rest of commodities, which makes sense. However, with China steadily reopening more and more, we could see a bit of a commodities obsession for a while over the next coming weeks or maybe even months, because commodities tend to move very slowly. That is what we are currently looking at. Remember, keep calm, keep cool, keep compounding. If you take those 10% wins on like 5 or 10% of your portfolio, it will compound. That is why we have many different positions open, or not necessarily many, but that's why we slowly scale in to limit our risk and to make sure that we calmly, collectively grow our portfolio. And then you'll still have very decent growth by year's end. All right. Thank you so much for your attention, and I will see you all in the next one. Bye bye.